When gold keeps setting new record highs, people are naturally either buying or panic Googling, should I buy gold?
Shut up and take my money!
Let's slow down and thoughtfully dive in. Welcome back to the smartest financial minds on YouTube. And for those of you who don't know me, my name is Steven Spicer. And over my 15 years in the financial planning industry, I've learned the value of gold exposure in a chaos hedged portfolio. So in this one, we're diving deep into one of the most frequently asked investment questions right now. Is this the right moment to buy gold? With gold prices breaking historical records and global markets experiencing volatility, understanding what's driving this surge is critical to making informed investment decisions. Now, gold has historically been viewed as a safe haven, an asset investors flock to during times of economic or geopolitical uncertainty. And recently, gold prices have skyrocketed, reaching new all-time highs. By April 2025, for example, they saw gold prices surge past $3,300 per ounce, marking a nearly 30% increase over just a few months. So what's fueling this incredible rise?
The US and China have been escalating their trade war by raising tariffs, even as President Donald Trump hit pause on tariffs for other countries.
First, let's talk geopolitics. Recent escalations in global tensions, especially between the United States and China, are significantly influencing investor sentiment. In April 2025, President Trump introduced tariffs of up to 145% on Chinese goods. China retaliated with tariffs of their own, pushing the two largest economies into a severe trade war. The ripple effects have been felt globally, causing market uncertainty and driving investors towards safer assets. Historically, gold has always reacted positively during times of heightened geopolitical tensions. Consider previous periods like the 1979 Iranian Revolution or the 2008 financial crisis. In both cases, gold prices soared as investors sought shelter from instability. Similarly, today's escalating US-China tensions and uncertainties in the Middle East and Eastern Europe are creating a comparable environment, further fueling gold's appeal. Another significant factor pushing gold higher is inflation fears. I prepare for the risk of prolonged and elevated inflation by creating what I call a chaos hedge. I walk you through that and so much more in our Financial Doomsday Survival Guide. I'll put the link to that in the description. Gold is one of the best assets for you to create your own chaos hedge. More on that in a bit. Anyway, as you've felt, inflation has been creeping upward, driven by disruptions in global supply chains and aggressive monetary policies from central banks worldwide. Gold is historically considered an excellent hedge against inflation because it retains purchasing power when currencies lose value. With inflation reaching levels not seen in decades, gold naturally attracts investors seeking stability. For example, during the high inflation of the late 1970s and early 1980s, gold experienced one of its most dramatic price surges, peaking in 1980. Today's scenario shares similarities: loose monetary policies, rising consumer prices, and diminished confidence in fiat currencies. These are all driving investors toward gold to protect their wealth. Now, speaking of central banks, they've also been actively increasing their gold reserves. Central banks around the world collectively bought hundreds of tons of gold in recent months, underscoring their lack of confidence in traditional reserve currencies, particularly the United States dollar. China's central bank, for example, added significantly to its gold holdings throughout early 2025. This institutional buying provides a stable foundation supporting gold prices. This trend isn't entirely new. Since the 2008 financial crisis, central banks worldwide have shifted toward gold accumulation, reversing decades of net selling. Countries such as Russia, China, and Turkey have been consistent buyers, viewing gold as a strategic reserve asset that offers protection against dollar depreciation and other geopolitical risks. Additionally, market volatility in traditional assets like stocks and bonds has increased gold's appeal. Equity markets have shown significant swings, and bonds, traditionally safe haven investments, have faced unprecedented volatility, just like I warned about in Stop Investing Like They Tell You, back when it was published in 2021. Anyway, the 10-year US Treasury yield, for example, recently saw its most significant weekly rise in over 20 years, signaling investors' concerns about future economic stability. In such turbulent times, gold's relative stability makes it attractive. Consider the volatile market conditions during the COVID-19 pandemic of 2020. When equities plummeted, gold quickly surged as investors sought safer alternatives. This scenario illustrates gold's value in diversifying and stabilizing an investment portfolio during periods of economic uncertainty. More recently, concerns about potential stagflation, where inflation is high but economic growth slows, have also boosted gold's appeal. In a stagflationary environment, most traditional investments struggle. Stocks suffer as profits stagnate, and bonds perform poorly due to rising interest rates. But gold? It often holds its value, or even appreciates. That said, investing in gold isn't without risks and downsides, so of course, let's clearly outline those. First, gold doesn't provide dividends or interest, so if you're looking at it as an investment, unlike stocks and bonds, gold sits idle, meaning your returns depend solely on its price appreciation. That means while gold may preserve wealth, it doesn't generate income. Second, gold prices can be volatile in the short term. Although it's considered a safe haven, gold is not immune to market corrections. After hitting highs, it often undergoes sharp pullbacks. For instance, after peaking in 2011 at around $1,900 per ounce, gold fell below $1,100 by 2015, a loss of over 40%. That's a painful drop for those who bought at the top. Third, storage and security can be a concern, especially with physical gold. Storing gold securely might mean paying for vaults or insurance, which adds to the total cost of ownership. Even digital gold and gold-backed ETFs carry some counterparty risk. And finally, timing the market is notoriously difficult. While buying gold during uncertain times can be profitable, knowing exactly when to enter or exit can challenge even the most seasoned investors. So I'm definitely not recommending that. That's why for the most part, I'd recommend viewing it for its potential as a chaos hedge instead of as an investment. I'll explain that idea of creating your own chaos hedge here in a bit. But in short, we'd recommend holding a moderate amount of gold, typically around 8 to 12% of a balanced portfolio. It's not about betting on gold. It's about using it as a hedge. To build up that position, consider dollar cost averaging. Instead of investing a lump sum at one peak price, you spread your investments out over time. This reduces the risk associated with price volatility and removes the pressure of perfectly timing the market. With gold, just like with stocks, gradual accumulation can reduce emotional decision making. It's also worth exploring the different ways to invest in gold. Where possible, I personally prefer physical gold. Bars and coins provide tangible ownership, but require storage and may come with liquidity limitations. There are also gold ETFs. These offer convenience and liquidity, allowing investors to track the price of gold without owning it physically, but they do have that counterparty risk that we talked about. You could consider gold mining stocks. These can offer leveraged exposure to gold prices, but also introduce company-specific risks like poor management or mine shutdowns. You have gold mutual funds and gold-focused hedge funds. These offer diversification within the gold sector, but often come with higher management fees. And finally, there are also digital gold platforms, a growing option for tech-savvy investors. These platforms allow fractional gold ownership without the logistics of physical delivery. Each of these vehicles has different tax treatments, risk profiles, and cost structures. Understanding these differences can help align your investment here with your broader financial goals. One overlooked aspect is how gold behaves relative to real interest rates. When real interest rates, that's nominal rates minus inflation, are negative, gold tends to shine. Why? Because holding cash or bonds underperforms and gold becomes more attractive as a store of value. With real interest rates trending negative in many parts of the world, this tailwind could continue. Also consider currency risk. If you're investing in gold from outside the US and the dollar weakens, gold priced in your local currency may rise even further. Many investors in emerging markets turn to gold not just as an investment, but as a way to protect themselves from currency depreciation or capital controls. From a behavioral finance perspective, gold also plays a psychological role. It's often seen as a financial security blanket, something that offers peace of mind when the rest of the financial system seems fragile. That sentiment, while intangible, can powerfully influence market demand. Finally, don't overlook the role of gold in estate planning and wealth transfer. Because it's a globally recognized store of value, gold can function as a discreet and efficient way to pass wealth between generations. Physical gold can be stored privately and, depending on local laws, may not trigger the same reporting requirements as other financial assets. Of course, consult a qualified estate planner, financial planner familiar with these particular laws in your area before making these types of decisions on this basis. But this is just another reason gold continues to hold appeal for high net worth individuals. So yes, gold is currently experiencing substantial growth driven by geopolitical uncertainties, inflationary pressures, central bank purchasing, and increased market volatility. But as with all investments, it never is a silver bullet, or in this case, a golden one. If you choose to go down this path, it should be integrated thoughtfully into your broader financial strategy. Now, as for the concept of building out a chaos hedge, gold is just one of the assets I recommend for that. I break that all down, including how devastating it could be if you do not have a chaos hedge to protect your wealth in this video. I look forward to seeing you there. Take care.